Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how markets are responding to the progress of reopening the economy. And Phil, stocks a little bit lower after a 5-day win streak as fears over COVID-19 weigh on sentiment. And I'm really not quite sure what changed today versus the crazy run that stocks had yesterday.
Yeah, I think I agree with you. The data on the COVID is pretty much the same as yesterday. Although the market was looking more negative before we got to the open than after the open. So maybe the market's kind of agreeing with us. I think yesterday was a little bit of an overshoot, though, also because it was driven by some news out of China where the government seemed to be at least verbally supporting investing in stocks and creating a market rally. That's not necessarily sustainable and it's not based on fundamentals. So potentially people had a double check on that as well. But looking at the new cases, you can definitely see the sort of bifurcation between states that reopened too early, states that reopened a little bit later, and the states that stayed closed for quite a long time. And it's interesting because the grey line on that chart is looking a lot like Europe, where a little bit of pain early on has resulted in much lower risk for being outside and doing things nowadays, whereas the states that opened a little too early or a lot too early are now seeing an increase in their cases. And obviously we've been talking about it for days now, but the Southwestern or the Sunbelt states are actually starting to see stress on their hospitals. They're starting to see people change their consumer behavior. And you can see that from the chart on the right-hand side here, where the Arizona, California, Florida, and Texas movement and economy is already starting to slow. There's other data out there as well that's just showing that the rest of the US, having seen a pretty strong recovery throughout April, May, June, is starting to slow down as well, just because a lot of the things that we still haven't opened are going to be much more tricky to open, just given the extra risk of and sort of the human behavior nature of doing things like going on holidays, on airplanes, in hotels.
That said, there are some positive trends that have been concerned in other sets of data.
Yeah, we've been talking about that's probably one of the reasons driving the market. So you've got, I've popped in a chart today just looking at one of the charts the Fed does. So they've got this forecaster that looks at all of the economic news and puts it together with a regression that sort of tries to estimate the GDP, and it does a pretty good job of it. So as the daily data came in through May, you can see the forecast, the black line, which is forecasting GDP for the quarter, dropped significantly. And so a lot of the unemployment data, a lot of the shutdown data filtered itself through the system and made it look like we may have close to a 40% year-on-year annualized retraction in GDP. And then you can see the last few weeks, like most of June, net, the data is surprised. So we've talked about the fact that unemployment has been improving. The payroll data is improving, retail spending is improving, people are getting back to work faster than possibly people thought. And so as that's happened, the forecaster has also changed the GDP forecast back closer to 15% down for the quarter year on year, which is a much better result than what we thought a month and a half ago. And so that's part of the reason why fundamentally the stresses that might have been priced into the market might have been overdone. And that's why the market's recovering as well as it is.
But Phil, with so many businesses shutting down, particularly we're hearing about bankruptcies in retail, we're starting to hear some in the energy space. We're not hearing much about corporate defaults.
Yeah, but they are happening. So there's some interesting data we put in here today from S&P just showing that globally defaults on corporate bonds seem to have roughly doubled so far. A lot of that's coming from the US, but it's also coming from other countries. Which makes sense. I mean, we know that companies are going to be under strain. We know that a lot of companies have lost lots or a material part of their income, and they may still have expenses. So there's a lot of companies that are sneaking into bankruptcy as well, which we've also shown in the chart today. It looks like bankruptcies in the US have more than doubled in the last quarter, which like you said, we've seen it in retail. We've seen a couple of energy companies. Hasn't really made the news as much as back in the credit crisis when lots of companies that were pretty high profile were going bankrupt. But definitely there is credit risk. There is bankruptcy risk. The banks priced it into their earnings back in Q1. And at the time, it seemed like maybe the banks were being a bit conservative, but we're starting to see some of these credit exposures coming through.
And what about state and local budget shortfalls? That's also starting to creep into the conversation as well.
It's definitely creeping into the conversation. I think it's one of the potential sticking points for the next rescue plan that the federal government's going to make as well, because there's debate about whether the federal government should be rescuing specific states. But the shortfall, just because states have funded a lot of the COVID medical expenses, but they've also lost a lot of consumption tax revenues and income tax revenues. So the shortfall that they're looking at for next year is pretty material. This estimate we've got today shows over $400 million shortfall. $400 billion shortfall. So it's a material amount of money. It potentially will come from some of the rescue package if we get that passed in the federal government. But this has implications for the muni bond market, which don't seem to be priced in that much at all. So muni bonds in the US are funding local government expenses and debt. And at the moment, the muni bonds have actually performed pretty well.
All right, Phil, and let's take a look at the natural gas complex, because we keep hearing about the fall in energy demand, and now you're starting to hear that in the natural gas space.
Yeah, I mean, it makes total sense. If you've got the same sort of dynamic going on where people aren't flying and they aren't driving, there's a lot less demand for oil and gas. Gas, I guess, is a little bit more specific because you can't put it on airplanes so well. You tend to use it just for heating and electricity production, but even electricity production is down globally. The news on this topic, though, seems to be coming more out of Europe, so potentially it's more of an exposure to Europe. You can see the chart here. The US prices of gas have been pretty range-bound, really, since March when this all started to happen. But it's just something to watch. Maybe this will be a problem for gas futures in Europe, whereas we had the oil problem for oil futures in the US specifically. But people are starting to talk about the fact that gas is still coming out of the ground. It's still being manufactured, and the demand for it is just not there like it used to be.
All right, so lots of stuff to cover today. Thanks so much for joining us on Trade Talks.
You're welcome, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.